The decision was made earlier on today by the Bank of England to hold interest rates at 5.25%. Some of you will know that over the last year or so, interest rates have gradually been pushed up in the UK and in other countries as well. And this is all a response to inflation. So from about mid to late 2020, inflation, this is a graph for the UK, but it happened elsewhere in the world as well, largely due to Russia invading Ukraine and oil prices went up. It shot right up. And essentially what inflation means is that the cost of buying stuff is going up. And that is quite quick for prices to go up, right? We sort of expect the price of things to go up over time. It's also kind of desirable. I did an interview with Unlearning Economics about this, and he made the really good point that the percentage that you put on inflation depends on exactly what you're measuring the price of. So this figure in this graph that we've got here is the consumer price index, which is essentially calculated on, they call it like a basket of goods. The idea is that it's a basket of goods that your average person in the UK might buy. And so they pick like specific products. So they pick like the average cost of a PS5 might be in there. I don't know if it is. The average cost of beans, the average cost of Mr. Blobby outfits, whatever it is, they pick a specific things and they like judge those over time, and they change what those things are over time depending on whether those are things that it is deemed useful to measure. And that started to go up and up and up. And in order to kind of try and curb that, what happens is what's often called like a reserve bank or a central bank in whatever country you're in. They will increase the interest rate, and this is essentially the amount that it costs banks to borrow money from the central bank. The like important knock-on effect of this is that this puts the cost of loans up, so it pushes the costs of mortgages up in particular. That's the really important one, but it also pushes up the cost of like your credit card. Maybe it puts up the cost of mobile phone contracts, and it also puts the return that you'll get on a savings account up. Like back then, putting money in a savings account probably didn't seem that attractive. You're like, well, I might as well spend the money, right, if it's not going to be earning any interest in a savings account. Whereas now you go, oh, if I put my 100 quid in a savings account, by the end of the year it's 105 quid. I might hold off on buying whatever the thing is. It puts the brakes on people's spending, right? And the idea is that if you're putting more money in your savings account and you're not taking out a loan to be able to buy something that you couldn't afford if you didn't take out a loan, then less people will be buying stuff. And so shops will have to and companies will have to put prices down to encourage more people to buy the things. And the hope is that that stops this inflation number going up and up and up and up and up. That's the way you would probably be taught it in an economics, like an Econ 101 module, or if you watch the BBC. The problem is that this isn't always the reason that inflation is happening. So one of the theories behind inflation rising in the US, and in fact the fact that it was happening in the UK as well as the US perhaps suggests that this wasn't quite true. There was a lot of speculation that inflation was because of the stimulus checks that have been handed out, right? So people had got their, was it $2,000? $1,200. So the idea was that people had got these $1,200 and they'd all gone crazy spending this money, and that had caused inflation to go up, which obviously the fact that it happened in the UK as well suggests that not true. And in actual fact, it was to do with several things. A lot of the energy bill spikes. So a huge amount of this in the UK was that energy prices went up massively last year in particular, but prices are still high now. A few years ago, I would pay like 20 quid a month for electricity in like a good month. Now it's like 200 quid. A lot of that wasn't that fuel prices were actually going up. A lot of it was profiteering, right? A lot of it was just energy companies deciding that they wanted to earn more money, which suddenly making savings accounts pay more and making people's mortgages cost more and making it harder to borrow money, that doesn't bring down the cost of energy bills. This increasing interest rate ended up kind of being another way in which we ended up with another kind of age disparity in terms of people's experience of life in the early 21st century. So for example, so if you are someone who is like a boomer and you bought a house at the right time, back when houses were affordable in comparison with salaries, and you've paid off your mortgage, this doesn't affect you a huge amount. Like, yes, you're not earning as much from any like savings you've got, but your main outgoing, housing, is not really costing you anything. If you've just bought a house, it could be a pain. Like, I know friends that had bought houses like a couple of years before when the interest rate was quite low, and then it shot up, and then their mortgage interest was like 5.5%, 6%. Because that's the interest rate over a long, like, decades worth of time, that can suddenly make 500 quid's worth of difference to a mortgage like that, and that's just money that you have to pay the bank now. But also, where landlords had mortgages on their houses and they shot up by hundreds of pounds a month, what they did was just passed them on to their tenants. And so tenants ended up getting punished for someone else having taken out a loan. All of this became one further way in which boomers had kind of managed to avoid what for everyone else became quite punishing. On the news, they'll often talk about interest rates and mortgage rates as though they only affect mortgage havers, but actually most landlords will just pass the increase on to their tenants, and so it affects them as well massively. You can get a thing called an interest-only mortgage where you essentially never pay off the mortgage itself. You just pay off the interest percentage. And those tend to have higher interest rates anyway because the bank is not getting their money back, really. If you're like a normal person who just wants to buy a house with a mortgage, going interest only is often like a last resort. In the UK, at least, banks like to avoid kicking someone out of a house and selling it. Generally for them it's easier and it makes more financial sense to try and let the person, like, they don't want the hassle of having a house and having to sell it. That's a nightmare. And so yeah, generally the existence of those things is an unstable thing, right? They're only offered to people at unstable times or landlords who seem to have a really good plan.